You need to know who your investors are and their appetite for risk. And so if you have investors that have less appetite for risk, then you want to steer them towards debt because it'll be an easier sell for you and they'll sleep better at night. If you have other investors who are like a lot of investors in this industry today, they don't mind risk. They're looking for higher risk deals for higher returns. And I mean, we found this with our preferred equity fund. There are a lot of people who they don't want fixed returns, even if they're much lower risk. They're happy to take the risk and potentially get much higher returns. And so for them, they're not going to be interested in a debt offering. Figure out the risk appetite for your investors, survey them. Just, I mean, basically say, hey, if you had a choice between a lower risk option at these returns, would it make up numbers that you think your debt options would be versus these higher risk options at these returns? Where do you land? How would you weight that? How much of your money, if you had $100,000 or $1 million, how much would you put in each of those things? Just ask it in a way that you can gauge, are they 100% opposed to the other option or do they lean one way or the other? You really have two choices with capital raising. You either figure out what your investors want and you give them that, or you figure out what you have and then you go find investors that want that. And that second way is much harder. It's a lot easier to just give your investors what they want because those are the ones that already know you, trust you, like you, ready to invest, as opposed to starting over because you just happen to have a different type of deal. And we say no to deals all the time because they might be great deals, but I'd have to start from scratch to build an investor base for those types of deals. And that's a whole new business in and of itself.